The world is watching the wrong conflict. While governments debate tariffs, currencies, and stock market swings, a far quieter and far more consequential struggle is unfolding beneath the surface. It is a conflict without missiles, without armies, without the noise of traditional warfare. Instead, it is fought with export licenses, refining quotas, and strategic classifications. It is the emerging global war for silver, a resource that has quietly become one of the most critical materials of the 21st century. For decades, Western economies operated under a comforting illusion that the global marketplace functioned like a supermarket. If a nation had dollars, it could buy whatever it needed. If Samsung required silver for a new battery, or Tesla needed it for solar roofing, the metal would simply appear. The assumption was simple: money equals access. But that assumption is collapsing. A new era of resource nationalism is taking shape, a polite term for a harsh reality. Countries that possess critical materials are beginning to restrict access to those that need them. China has now signaled a shift that could reshape the geopolitical landscape. Internal reports and policy movements indicate that Beijing is preparing to classify silver not as a precious metal, but as a strategic mineral. This change grants the state sweeping authority to restrict exports and prioritize domestic industries over foreign buyers. The timing is deliberate. Silver has become indispensable to modern technology. It is no longer merely a monetary metal. It is a foundational component of the green economy. Solid-state batteries, high-efficiency solar panels, and advanced 5G electronics all depend on it. China dominates the manufacturing of these technologies. It produces the majority of the world's solar panels and a large share of its batteries. If China runs short of silver, its industrial dominance weakens. So Beijing is taking steps to ensure that does not happen. History offers a clear warning. In 2010, China restricted rare earth exports to Japan, causing prices to spike by 2,000%. In 2023, it imposed licensing requirements on gallium and germanium, disrupting semiconductor supply chains overnight. Now, attention is turning to silver, a metal far more widely used and far more economically critical. Unlike gallium, silver is embedded in nearly every modern system: solar panels, electric vehicles, medical equipment, consumer electronics, and military hardware. A Chinese export restriction would not merely inconvenience Western industries, it would destabilize them. It would slow the green transition, disrupt the EV market, and strain global manufacturing. China's strategy is subtle but effective. Although it is a net importer of silver, it controls a critical choke point: refining. Much of the world silver ore, especially from Mexico and Peru, is shipped to China for processing. Once the concentrate arrives, it falls under Chinese jurisdiction. If Beijing restricts the re-export of refined silver, the global supply chain tightens instantly. The metal enters China, but it does not leave. This dynamic has already begun to reshape global inventories. Western vaults in London and New York have been draining for years. The metal is flowing eastward toward the smelters and factories that now form the backbone of global production. The West, having outsourced its refining capacity decades ago, finds itself dependent on a system it no longer controls. The roots of this vulnerability lie in policy decisions made in the 1990s and 2000s. Smelting is energy-intensive and environmentally damaging. Western nations tightened regulations and allowed their refining industries to wither. China, meanwhile, embraced the role. It built vast metallurgical zones, subsidized energy costs, and accepted the pollution. In return, it gained control over the world's processing infrastructure. This control gives China leverage. Even if it does not mine the majority of the world's silver, it processes a significant share of it. In a shortage, the toll gate can close. Export licenses can be delayed. Quotas can be reduced. The global market can be squeezed without a single mine shutting down. The motive behind this strategy becomes clear when examining China's solar industry. China controls more than 80% of the global solar supply chain. Its rapid shift to TOPCon technology, which requires significantly more silver, has created enormous internal demand. In 2023 alone, China's solar sector consumed nearly a quarter of global silver mine supply. As installation targets rise, this demand will only grow. If global silver prices surge due to shortages, Chinese manufacturers suffer. But if China restricts exports, it creates a dual-price system: affordable silver domestically, expensive silver abroad. This gives Chinese companies a decisive competitive advantage. Western manufacturers, already struggling to rebuild domestic solar production, would face soaring input costs. China, meanwhile, would strengthen its grip on the global energy transition. As China tightens its grip on the refining choke point, the consequences ripple far beyond its borders. The West is beginning to confront a reality it spent decades ignoring. A digital economy cannot function without physical materials. Artificial intelligence, renewable energy, and electric vehicles, all of them depend on metals. And among those metals, silver stands apart. It is not simply useful, it is irreplaceable. No other element combines conductivity, reflectivity, and malleability in the same way. Without silver, the green transition slows, and in some sectors, it stops entirely. This is why the shift in global inventories is so alarming. For years, analysts have watched the London Bullion Market Association and COMEX vaults drain. At first, the decline was dismissed as investor rotation or temporary supply tightness, but the pattern persisted. The metal was not disappearing, it was migrating. It was flowing toward the east, toward the smelters, the factories, and the industrial ecosystems that now anchor global manufacturing. The West, having outsourced its processing capacity, now finds itself dependent on a supply chain it no longer controls. The vulnerability becomes clearer when examining the structure of silver production. Most investors imagine silver mines producing gleaming bars of refined metal. In reality, the majority of silver is produced as a byproduct of mining other metals, primarily lead, zinc, and copper. When a mine in Mexico or Peru extracts ore, it does not produce refined silver. It produces concentrate, a heavy, toxic mixture containing small percentages of silver mixed with other minerals. To turn this concentrate into 9999 fine silver bars, a smelter is required. And over the past 2 decades, China has built the world's most extensive smelting infrastructure. This shift did not happen by accident. It was the result of deliberate policy choices. Western nations tightened environmental regulations, raised energy costs, and allowed their smelting industries to decline. China, meanwhile, embraced the role. It built massive industrial zones dedicated to metallurgy, subsidized electricity, and accepted the pollution that came with it. In exchange, it gained control over the processing stage of the global metal supply chain. Today, even if silver is mined in the Americas, much of it must travel across the Pacific to be refined. Once the concentrate arrives in China, the dynamic changes. Possession becomes power. The silver inside that concentrate falls under Chinese jurisdiction. If Beijing decides that strategic metals cannot leave the country, the silver stays. It does not matter that it was mined in Mexico or owned by a Canadian company. It is now part of China's internal supply. This gives Beijing a powerful lever. It can restrict exports without touching the mines. It can tighten global supply without producing a single ounce less. This refining dominance explains the growing divergence between Western and Eastern markets. In a free market, arbitrage keeps prices aligned. If silver is cheaper in one region, traders buy it and ship it to where it is more expensive. But when export restrictions are introduced, arbitrage breaks, prices decouple, a dual market system emerges. Silver inside China becomes cheaper and more accessible to domestic manufacturers. Silver outside China becomes scarce and expensive. This dynamic gives Chinese companies a structural advantage in industries that rely heavily on silver. The solar industry is the clearest example. China controls more than 80% of the global solar manufacturing supply chain. It produces the polysilicon, the wafers, the cells, and the modules. But solar panels are not made of ideology. They are made of materials. And the most expensive non-negotiable material in a solar cell is silver. As China shifts to TOPCon technology, which requires significantly more silver, its internal demand is exploding. In 2023 alone, China's solar sector consumed nearly 200 million ounces of silver. As installation targets rise, this demand will only increase. If global silver prices surge due to shortages, Chinese manufacturers suffer. Their margins shrink. Their competitiveness weakens. But if China restricts exports, it creates a dual price system. Domestic manufacturers enjoy stable, affordable silver. Foreign competitors face soaring costs. This strategy allows China to maintain its dominance in the solar industry while the rest of the world struggles to secure raw materials. The implications extend beyond solar. Silver is essential for electric vehicles, 5G infrastructure, medical equipment, and advanced electronics. As demand rises across these sectors, the supply pressure intensifies. China understands this. It is positioning itself not just as a manufacturer, but as a gatekeeper. By controlling the flow of refined silver, it can influence global industries without firing a shot. This strategy aligns with China's broader economic doctrine, dual circulation. The goal is to make China self-reliant internally while ensuring the rest of the world remains dependent on Chinese exports. Silver fits perfectly into this model. By hoarding the raw material and exporting the finished technology, China maximizes value and influence. It becomes both the workshop and the warehouse of the world. But China is not the only player in this emerging resource war. Latin America, home to the world's largest silver deposits, is awakening to its own leverage. Mexico, Peru, Bolivia, and Chile collectively control the tap. For decades, foreign companies extracted their resources, refined them abroad, and captured most of the profit. As silver prices rise and geopolitical tensions escalate, these nations are reconsidering that arrangement. A wave of resource nationalism is sweeping the region. Governments are exploring higher taxes, export controls, and domestic refining requirements. The logic is simple. If silver is a strategic asset, why allow foreign corporations to extract it cheaply? Why allow China to refine it? Why allow the West to profit from it? The shift began with lithium. Chile nationalized its lithium industry. Mexico created a state-run lithium company. Bolivia tightened control over its reserves. Now, the same logic is being applied to silver. As prices rise, governments see an opportunity to capture more value. They see foreign miners earning record profits and ask why those profits are not staying in the country. This trend could reshape the global market. A coordinated move by Latin American producers, even something as simple as a unified export tax, could raise the price floor. It would increase political risk for miners and further strain Western supply chains. The concept of a silver OPEC is no longer far-fetched. The concentration of production is high enough, and the geopolitical incentives are strong enough to make such a coalition viable. The consequences for Western industries would be severe. Higher taxes and export controls would raise the cost of raw materials. Domestic refining requirements would slow supply. Political instability would add uncertainty. Companies that rely on silver, from electronics manufacturers to solar panel producers, would face rising costs and shrinking margins. This dynamic creates a new kind of geopolitical tension. China controls the refining choke point. Latin America controls the mining choke point. The West controls neither. It is caught between two forces, the processors and the producers. Both are asserting their interests. Both are demanding more value. And both are reshaping the global supply chain in ways that challenge Western assumptions. As these geopolitical forces collide, the global silver market begins to fracture. The systems that once governed pricing and distribution were built for a different era, an era of abundant supply, open trade, and predictable flows. The London Fix and the COMEX futures market were designed to manage financial speculation, not physical scarcity. They assumed that metal could always be moved from one region to another, that arbitrage would keep prices aligned, and that supply disruptions would be temporary. But those assumptions no longer hold. The modern silver market is no longer a unified global system. It is becoming a patchwork of regional markets, each shaped by political decisions, industrial priorities, and strategic interests. China's refining dominance creates one set of prices. Latin America's resource nationalism creates another. Western financial markets, increasingly disconnected from physical supply, create a third. The result is a world where silver no longer trades as a single commodity, but as a series of localized assets with different levels of accessibility and different strategic value. This fragmentation is already visible. Premiums in Shanghai have consistently exceeded those in New York. The metal is flowing eastward and staying there. Arbitrage, the mechanism that once kept global prices aligned, is breaking down. Export restrictions, logistical bottlenecks, and political tensions prevent the free movement of metal. The market is no longer governed by supply and demand alone. It is governed by policy, by strategy, and by the decisions of states. This shift exposes a deeper vulnerability in the Western financial system. For decades, Western institutions treated commodities as abstractions, as financial instruments to be traded, hedged, and speculated upon. The physical metal was secondary. What mattered were the contracts, the derivatives, the paper claims. But a paper claim is only as good as the metal behind it. And as physical inventories drain, the gap between paper and reality widens. The COMEX market, in particular, faces growing pressure. It was built on the assumption that physical delivery would be rare. Most contracts would be settled financially. But if physical supply tightens, and if industrial users begin demanding delivery rather than cash settlement, the system could strain. A short squeeze in a market with limited physical inventory could trigger cascading failures. Traders who are short silver could find themselves unable to source metal for delivery. Arbitrage, once the escape valve, would no longer function if exports from Asia are restricted. This is not theoretical. It is the same dynamic that unfolded in the gallium and germanium markets. When China imposed export controls, Western buyers could not simply turn to alternative suppliers. The supply chain was too concentrated. Prices spiked, inventories vanished, governments scrambled. The same pattern is now emerging in silver, but on a far larger scale with far greater economic consequences. The stakes are higher because silver is not a niche metal. It is embedded in the infrastructure of modern life. Every solar panel, every electric vehicle, every smartphone, every data center relies on it. The green transition, the shift from fossil fuels to renewable energy, depends on it. Policymakers assumed that the cost of renewable technology would continue to fall indefinitely. They assumed that raw materials would remain cheap and abundant. But those assumptions are being challenged. If silver prices rise sharply, the cost of solar energy increases. The deflationary trend that made renewable energy competitive reverses. The transition to net zero becomes inflationary. Governments face higher costs for infrastructure projects. Consumers face higher prices for electronics and vehicles. The economic model underpinning the green transition becomes more fragile. This vulnerability is amplified by the structure of the supply chain. The West relies heavily on imports for both raw materials and refined metals. It has limited domestic mining and even less refining capacity. Building new smelters is slow, expensive, and politically difficult. Environmental regulations, community opposition, and high energy costs create barriers. Even if the West decided today to rebuild its refining industry, it would take years, perhaps a decade, to reach meaningful capacity. Meanwhile, demand continues to rise. The shift to electric vehicles accelerates, solar installations expand, data centers multiply. Each of these sectors consumes silver, and each of them is growing. The result is a structural imbalance: rising demand, constrained supply, and limited flexibility. This imbalance gives leverage to those who control the choke points. China controls the refining choke point. Latin America controls the mining choke point. The West controls neither. This creates a new geopolitical landscape, one in which access to materials becomes a tool of influence. Nations that control critical resources can shape global industries. They can reward allies, pressure rivals, and protect their own economic interests. This dynamic is not new. It echoes the oil politics of the 20th century. But the stakes are different. Oil powered the industrial age. Silver powers the digital and renewable age. Control over silver means control over the technologies that define the future: clean energy, advanced electronics, and high-performance computing. It is not simply a commodity, it is a strategic asset. As governments recognize this, they begin to act. The United States and Europe talk about friendshoring, sourcing materials from allied nations. But this strategy faces a fundamental problem. Even if silver is mined in friendly countries like Mexico or Canada, much of it still travels to China for refining. The supply chain is not friendly. It is captured. Unless the West can convince producers to refine domestically or build new smelters, friendshoring remains an aspiration rather than a solution. Mexico, for its part, is reassessing its role. It is the world's largest silver producer, yet it captures only a fraction of the value. Foreign companies extract the metal, ship the concentrate abroad, and profit from the refined product. As prices rise, Mexico sees an opportunity to change this dynamic. It can impose higher taxes, require domestic refining, or restrict exports. Each of these measures would increase its leverage. Each would reshape the global market. Peru faces similar incentives. Political instability has already disrupted mining operations. As the value of silver increases, the pressure to capture more revenue grows. Governments see mining profits as a source of funding. They see foreign companies earning record margins and ask why those profits are not staying in the country. Resource nationalism becomes politically attractive. And these trends converge to create a new reality. The global silver market is entering an era of structural scarcity, not because the metal is running out, but because access to it is becoming restricted. Nations are prioritizing domestic industries. They are hoarding strategic materials. They are using resources as tools of policy. The supermarket model, the idea that any nation can buy what it needs on the open market, is collapsing. In its place emerges a world of gated supply chains, regional blocks, and strategic stockpiles. The West, having outsourced its industrial base, now finds itself on the wrong side of the gate. As the supermarket model collapses, governments begin to confront a truth they long avoided. The global economy is not built on digital abstractions, but on physical materials. The world's most advanced technologies depend on metals extracted from the earth, processed in energy-intensive facilities, and transported through fragile supply chains. Silver, once dismissed as a relic of monetary history, has become a cornerstone of the modern world. It is the quiet engine behind renewable energy, advanced electronics, and military systems. And as access tightens, nations are forced to rethink their assumptions about security, sovereignty, and strategy. The United States, long accustomed to commanding global supply chains, now finds itself in an unfamiliar position. It is dependent. It relies on foreign nations for critical materials, foreign companies for refining, and foreign governments for access. The industrial base that once made it self-sufficient has eroded. Smelters have closed. Mines have been shuttered. Environmental regulations, economic pressures, and political choices have hollowed out the infrastructure that once underpinned American power. The result is a vulnerability that cannot be solved with financial tools alone. Europe faces a similar dilemma. Its Green Deal, its climate targets, and its industrial policies all assume stable access to raw materials. But Europe produces almost no silver. It imports nearly all of it, and much of what it imports is refined in China. This dependence creates a strategic contradiction. Europe wants to lead the green transition, but it lacks the materials required to build the technologies that transition depends on. It wants to reduce reliance on China, but its supply chains remain deeply intertwined with the Chinese industry. It wants to secure access to critical minerals, but it lacks the political will to build the infrastructure necessary to process them. This tension is not merely economic, it is geopolitical. Nations that control critical resources gain leverage. They can shape global markets, influence foreign policy, and protect their own industries. Nations that lack those resources must negotiate, compromise, or adapt. The balance of power shifts. The world becomes less stable, less predictable, and more fragmented. This fragmentation is visible in the behavior of corporations as well. Multinational companies, once confident in the stability of global supply chains, now face rising uncertainty. They must navigate export controls, political risk, and shifting regulations. They must secure long-term contracts, diversify suppliers, and build strategic stockpiles. They must adapt to a world where materials are not simply commodities, but instruments of national strategy. The era of just-in-time supply chains is giving way to an era of just-in-case planning. The consequences extend beyond industry. They reach into the financial system. Investors who once viewed commodities as hedges or speculative instruments now confront a new reality. The price of silver is no longer determined solely by market forces. It is shaped by policy decisions, geopolitical tensions, and structural constraints. Traditional models fail to capture these dynamics. Analysts who rely on historical data find themselves unprepared for a world where supply can be restricted by decree, where refining capacity can be weaponized, and where regional markets can diverge sharply. This divergence creates opportunities for some and risks for others. Traders who understand the new dynamics can profit from regional price differences, supply disruptions, and policy shifts. But those who rely on outdated assumptions face losses. The market becomes more volatile, more unpredictable, and more sensitive to political developments. A single announcement from Beijing, a tax change in Mexico, or a strike in Peru can send prices soaring or collapsing. The silver market becomes a barometer of geopolitical tension. This tension is most visible in the relationship between China and the West. China's dominance in refining gives it leverage. It can restrict exports, prioritize domestic industries, and influence global prices. The West, lacking refining capacity, must either accept these conditions or attempt to rebuild its industrial base. But rebuilding is not easy. It requires investment, political will, and time. It requires confronting environmental challenges, community opposition, and economic constraints. It requires reversing decades of policy decisions that favored outsourcing over domestic production. Some Western policymakers recognize this challenge. They speak of reshoring, friendshoring, and strategic autonomy. They propose subsidies, tax incentives, and industrial policies. But these measures face obstacles. They require coordination, funding, and long-term commitment. They require a shift in political culture, a recognition that industrial capacity is not merely an economic asset, but a strategic one. And they require confronting the reality that rebuilding refining capacity will take years, not months. Meanwhile, China continues to strengthen its position. It invests in new smelters, expands its industrial zones, and secures long-term supply contracts with foreign miners. It builds strategic stockpiles, supports domestic manufacturers, and integrates its supply chains. It positions itself not only as the world S factory, but as the world AS processing hub. This gives it influence over industries that define the future: renewable energy, electric vehicles, and advanced electronics. Latin America, too, is asserting its interests. Mexico, Peru, Bolivia, and Chile recognize their leverage. They control the world's richest silver deposits. They see rising demand, tightening supply, and growing geopolitical tension. They see foreign companies earning record profits, and they ask why those profits are not staying in the region. Resource nationalism becomes a tool of economic development, political legitimacy, and strategic positioning. Governments impose higher taxes, restrict exports, and demand domestic refining. They seek to capture more value from their resources and reduce dependence on foreign corporations. This shift creates friction with Western companies. Miners face rising costs, regulatory uncertainty, and political risk. They must negotiate with governments, adapt to new policies, and navigate complex social dynamics. They must balance shareholder expectations with local demands. The result is a more challenging operating environment, one that reflects the broader transformation of the global economy. As these forces converge, the world moves toward a new equilibrium. It is a world where access to materials is not guaranteed, where supply chains are not neutral, and where resources are instruments of power. It is a world where nations must plan, adapt, and compete. It is a world where silver, a metal once associated with coins and jewelry, becomes a strategic asset at the center of global politics. The implications are profound. They affect energy policy, industrial strategy, national security, and economic stability. They shape the future of technology, the pace of the green transition, and the balance of power between nations. They force governments, companies, and investors to rethink their assumptions, revise their strategies, and prepare for a world defined not by abundance but by constraint. As the world enters this new era of constraint, the consequences begin to surface in unexpected places. Industries that once took silver for granted now confront rising costs, unpredictable supply, and growing competition. Solar manufacturers face tighter margins. Electric vehicle producers struggle to secure long-term contracts. Electronics companies reevaluate their supply chains. Even defense contractors who rely on silver for guidance systems, sensors, and communications equipment must adapt to a world where access is no longer guaranteed. The metal that once seemed abundant now reveals its strategic importance. Governments respond in different ways. Some build strategic stockpiles, quietly accumulating metal to protect their industries. Others negotiate long-term supply agreements with producing nations. Some invest in recycling, hoping to recover silver from discarded electronics and solar panels. But recycling alone cannot meet rising demand. The volumes are too small, the process is too slow, and the infrastructure too limited. The world remains dependent on primary supply, on mines, smelters, and the geopolitical dynamics that shape them. This dependence forces nations to confront uncomfortable truths. The green transition, often portrayed as a path to energy independence, relies heavily on materials controlled by a small number of countries. The technologies that promise a cleaner future depend on supply chains that are anything but clean. The metals that power renewable energy are extracted from the earth, processed in energy-intensive facilities, and transported across oceans. The dream of a sustainable future is built on a foundation of physical resources that are finite, contested, and increasingly politicized. This tension becomes a defining feature of the 21st century. Nations that control critical materials gain influence. Nations that lack them must adapt. The balance of power shifts. The world becomes more multipolar, more fragmented, and more competitive. The old assumptions, that markets are neutral, that supply is stable, that trade is predictable, no longer hold. In their place emerges a world shaped by strategic scarcity. This scarcity is not absolute. The earth contains silver. Mines continue to operate. New deposits are discovered. But access is constrained by politics, economics, and infrastructure. The bottlenecks are not in the ground. They are in the systems that extract, refine, and distribute the metal. These systems are shaped by national interests, corporate strategies, and geopolitical tensions. They are vulnerable to disruption, manipulation, and conflict. The result is a world where silver becomes more than a commodity. It becomes a measure of power. Nations that secure access can build the technologies of the future. Nations that fail fall behind. The competition intensifies. The stakes rise. The world moves toward a new equilibrium, one defined not by abundance, but by control over choke points. In this new world, the West faces a choice. It can attempt to rebuild its industrial base, investing in mining, refining, and processing. It can form alliances with producing nations, offering investment, technology, and political support. It can develop strategic stockpiles, diversify supply chains, and strengthen domestic industries. Or it can continue to rely on a system that no longer serves its interests. A system in which it is dependent on foreign nations for critical materials. Rebuilding will not be easy. It requires political will, economic investment, and long-term commitment. It requires confronting environmental challenges, community opposition, and regulatory barriers. It requires recognizing that industrial capacity is not merely an economic asset, but a strategic one. It requires a shift in mindset, a recognition that the world has changed and that old assumptions no longer apply. Some nations will adapt, others will struggle. The transition will be uneven, contested, and complex. But one thing is clear. The era of cheap, abundant silver is over. The world has entered a new phase, one defined by competition, constraint, and strategic calculation. In this new era, silver becomes a symbol of the broader transformation. It represents the shift from a world of open markets to a world of gated supply chains. It reflects the rise of resource nationalism, the fragmentation of global trade, and the growing importance of industrial policy. It reveals the vulnerabilities of the green transition and the challenges of building a sustainable future. It exposes the limits of financial systems built on assumptions of abundance. The supermarket is closing. The shelves are no longer full. The world must now navigate a landscape shaped by scarcity, strategy, and competition. The quiet war for silver, fought not with weapons but with policies, contracts, and choke points, becomes a defining conflict of the 21st century. And as nations compete for access, influence, and control, one truth becomes impossible to ignore. The future will be shaped not by those who consume the most technology, but by those who control the materials that make that technology possible. Silver, once overlooked, now stands at the center of this transformation, a silent force reshaping the global order.